Alright, let's get straight to it. There's a quiet but massive shift happening in the global drone market, and ignoring it could be a very expensive mistake. This isn't speculation, it's a policy-driven change that's creating a rare opportunity. Look, if you're short on time, or you just don't want to listen to some random cat on the internet, here's the one thing you need to know. The Pentagon has effectively blacklisted the world's largest drone maker, DJI. This isn't just a slap on the wrist, it's a multi-billion-dollar door swinging wide open for a handful of US allied companies. One of them is Kratos Defense. Hey, for those of you who are new here, my name is DataCat. I spent a long time as an analyst inside a Fortune 50 company, staring at spreadsheets until my eyes blurred after 4 cups of coffee. I guess you could say I've traded the corporate grind for a keyboard and a laser pointer. But my cat is taking a nap right now, so there might not be a huge difference. And for those of you who aren't new, I know, I was gone last week. My apologies for that. I'll try to be more consistent. If you appreciate this kind of no-fluff, data-first analysis, hitting that subscribe button is the best way to support the channel. It, helps me buy better catnip. For research, of course. Okay, so let's talk about what's really going on. This isn't just about one company winning and another losing. This is about a deliberate move by the US government that's reshaping an entire industry, and it's creating an opportunity that most retail investors haven't even noticed yet. Now, imagine you're the biggest cat in the neighborhood. You're DJI. You own 90% of the territory. Life is good. Then one day, the biggest house on the block, the Pentagon, puts up a sign that says DJI is not welcome here. That's essentially what happened last week. A recent US federal court decision kept DJI on something called the Section 1260H list. That's the Pentagon's official list of Chinese military companies. Now, this isn't an outright ban for you, the consumer, but for anyone with federal funding, government agencies, state and local departments, critical infrastructure projects, it's a massive red flag. The Department of Defense is making it crystal clear: avoid Chinese-made drones. And when the US government makes a move like this, its allies around the world tend to listen very carefully. So, if the biggest player is being pushed out of the most lucrative contracts, where does all that money go? Well, it goes to companies that are compliant, companies that are US-based or allied. And that brings us to one of the companies called Kratos Defense today, ticker symbol KTOS. So why Kratos? Well, the demand I just mentioned aligns almost perfectly with what Kratos does. The Department of Defense is pivoting hard toward what it calls attritable autonomous systems. A fancy way of saying smart, effective drones that are affordable enough to lose in a conflict without a general having a heart attack. This, along with hypersonics and satellite ground systems, is Kratos' bread and butter. The company is reporting a record bid pipeline of around $13 billion, and they have a consistent book-to-bill ratio of about 1.2. For anyone unfamiliar, a book-to-bill over 1 is a very healthy sign. It means more new orders are coming in than the company is filling, so the backlog of work is growing, suggesting huge demand. But that's not all. What really makes Kratos stand out, though, is its business model. They use a fast-to-field approach. They actually pre-invest their own money to build their drones, like their flagship XQ-58A Valkyrie, before they even have a contract locked in. This is unusual in the defense world, but it gives them a huge edge. It shows potential buyers like the US Air Force or international partners that they can deliver and deliver quickly. This is basically the corporate equivalent of a stray cat dropping a dead mouse on your doorstep. A bit startling maybe, but you can't deny the initiative. This very strategy has already led to sole source positions and significant international traction, like a partnership with Airbus to get a version of the Valkyrie to Germany by 2029. And here's a critical point. The company's own financial guidance, their base outlook, doesn't even include potential revenue from large-scale production of these tactical drones. Any major program of record orders from the US Marine Corps or European allies would be stacked right on top of their existing growth case. The momentum is already visible in their numbers. In the second quarter of 2025, their revenue grew 17% year over year to over $350 million. along with their total backlog, stands at about $1.4 billion. The Marine Corps is advancing its testing of the Valkyrie, and while the Air Force's first batch of new drones went to competitors, Kratos is in a sweet spot for the second batch, which is expected to focus on lower-cost designs. Now, of course, no investment thesis is without risk. We have to look at the other side. The big contracts for the Valkyrie aren't locked in yet. The timing is uncertain, and competition from companies like Anduril and General Atomics is intense. Kratos is also still working through some older, lower-margin, fixed-price contracts from a few years ago that are weighing on their profitability until they can be repriced. So what could this look like going forward? Management's own view is conservative, but so did Anthony Noto and Jensen. Look where SoFi and Nvidia are. And if we start to layer in some of these potential drone awards, the picture gets very interesting. Let's run through a plausible base case scenario. And remember, these are just directional estimates to frame the potential, not official company guidance. Let's assume Kratos gets an initial small production order from the Marine Corps for maybe about 15 Valkyries in fiscal year 2026, with more to follow. Let's also assume their core businesses continue to grow at a healthy 10 to 12%. Under that scenario, you could see revenue growing from roughly $1.45 billion in 2026 to $1.65 billion in 2027, and potentially hitting $1.9 billion by 2028. So the fundamental story here is compelling. You have a clear policy tailwind, a company with a unique and proven strategy, and multiple paths to significant growth that aren't even priced into their base outlook. We should just smash the buy button now, right? Well, as you should already know by now, the fundamentals are only half the story. A great company doesn't always mean a great stock to buy right now. So, what does the chart look like? What are the key price levels we need to watch? And this is where we see a classic conflict. It's a battle between that powerful long-term fundamental narrative we just discussed and a severely overextended short-term technical picture. The company is fundamentally in a great spot within a bullish sector, but the stock's price, well, it appears to have run far ahead of itself. This signals a high probability of a near-term pullback or a period of consolidation. And for a patient investor, that could be the opportunity we're looking for. Let's look at the bull case on the chart first. The 3-month daily chart really reflects the market's excitement. The stock has posted a staggering 99% gain over just 60 trading days. It has a perfect trend strength score, which shows a powerful confirmed uptrend. And this rally is justified by the fundamentals we talked about: their strategic positioning, the strong revenue growth, and the raised guidance. The volume analysis also shows a trend of accumulation, which is just a way of saying that over the last 3 months, buyers have been more aggressive than sellers, absorbing shares and pushing the price higher. However, and this is a big however, the short-term picture is flashing some pretty clear warning signs. The data from the last week, looking at the 5-day hourly chart, sends a unified bearish signal. The stock's upward momentum has stalled and several indicators are pointing to exhaustion. First, the technicals are overheating. On a short-term basis, the RSI and the stochastic are firmly in the overbought territory. More importantly, the hourly chart is showing a momentum divergence. Now what that means is that as the stock's price pushed to its recent highs, the underlying momentum, the actual force behind the move, was getting weaker. It's a classic leading indicator of a potential trend reversal. This time, the cat might be ready to pounce, but you can see its tail isn't twitching with the same energy anymore. The intent is there, but the power is fading. The price is also very extended. It's currently trading over 3% above its 5-day VWAP. That's a significant deviation, and it suggests the price is stretched and likely to revert back toward that average, which is sitting around $83. So, what's coming next? In the short term, say the coming week, there is a high probability of a pullback. The path of least resistance right now is sideways to down. The initial target would be a move back toward that $83 VWAP. The most critical level to watch though is the support established over the last week at around $78.80. A break below that this week would confirm the bearish signal and could lead to a deeper correction. Now, in the medium term, over the next 1 to 3 months, the stock's reaction to this initial pullback will be crucial. The powerful uptrend isn't broken, but it is being tested. If Kratos can hold above the first major Fibonacci support level from its big run-up, which is just above $76, it would actually be considered a healthy consolidation. This isn't a bad thing. In fact, a pullback and a period of consolidation leading into its next earnings report in November might be a very good thing. It allows the overbought technicals to reset, lets the stock catch its breath, and sets up a much healthier platform for the primary uptrend to resume. But if it fails to hold that $76 level, it would signal a deeper correction is underway, with the next major support zones around $70 and then the prior breakout level of $68.75. So to put it all together, we have a fundamentally strong company that has run a long way, but perhaps running a bit too quickly. As we enter October, the smart play here requires patience. We need to watch for that pullback, see where support is found, and let the chart reset itself before considering an entry. And if you found this breakdown useful, and you want to see more deep dives into the data behind the market, please consider subscribing to the channel. It's a huge help for a new creator like me. Alright, that's all for today. DataCat out. Stay sharp and stay safe out there.